was the title is important because every central banker or economic official says this time is different. And yet the basic themes of debasing a currency, inflation, lack of spending discipline, Reinhart and Rogoff highlight the similarity of poor action by bankers and governments to destroy their economy through a lack of discipline. And it's an important lesson for us. We have a report from the National Council of State Legislators that talk about financial stress now in 12 American states. Just recently, the state of Illinois borrowed another $3.7 billion, paying 50 basis points more to borrow than corporate debt at the lowest investment grade. You and I talked earlier about the potential of states posing a systemic risk to our economy. Do you feel that they could pose a systemic risk?
It's possible, but currently, while states are facing very tough financial conditions, at least as long as the recovery continues, they are seeing higher tax revenues, and that will at least be helpful to some of them in trying to address these problems. But obviously, this is something we have to watch carefully.
Certainly a panic in the state and municipal bond market could trigger a systemic risk, in your view.
If it was sufficiently severe, yes.
Yeah. When you have expressed opposition to any federal bailout of the states, is that correct?
I think that it's a congressional federal matter. It's not a Federal Reserve matter. The Federal Reserve is not going to be involved in that. If Congress wants to address it, that's...
Or what would your view be to accelerate federal borrowing to give money to the states?
Again, I think that's a congressional decision. If you're going to be increasing borrowing, though, obviously that bears its own risks, obviously.
Right. I would think tremendous. Would you regard the proposal to defer state payments of principal and debt on loans made from the federal government as a state bailout?
Well, it has, to some extent, it has fiscal implications for the federal government.
I would think so. I also hope maybe we could use a language that is more clear. In your testimony on page 5, you talked about we are considering providing additional monetary accommodation through further asset purchases. In November, the committee announced that it intended to purchase additional $600 billion in longer-term Treasury securities in the middle of this year. In more layman's terms, you're talking about lending money to the U.S. government, correct?
Well, not exactly, because we're buying these securities on the secondary market. So somebody has already lent the money directly. But yes, we are holding government debt.
Yeah, my point exactly. Section 14 of the Federal Reserve Act legally prevents you from, well, this would say from buying newly issued securities, which in a more layman's term would be lending directly to the U.S. government.
And that's why we're not doing that.
Right. But instead what you do is others lend to the U.S. government, and then you buy their loans.
Well, we do that all the time, and even in most normal conditions.
Correct. The CRS says in modern times the Fed has always held Treasury securities as part of normal operations, but now under QE2 it's a $600 billion commitment. But the CRS goes on to say, nonetheless, the effect of the Fed's purchase of Treasury securities on federal budget is similar to monetization, whether the Fed buys securities on the secondary market or directly from Treasury. When the Fed holds Treasury securities, Treasury must pay interest to the Fed as it would to any private investor. These interest payments after expenses become part of the profits of the Fed. The Fed, in turn, remits 95% of the profits to the Treasury, where it is added to the general revenues. CRS concludes, in essence, the Fed has made an interest-free loan to the Treasury because almost all of the interest paid by the Treasury to the Fed is subsequently sent back to the Treasury. Would you agree with that?
Yes, we've remitted $125 billion to the Treasury in the last 2 years. So it's important to understand that what we're doing is not fiscal spending. It is, in fact, purchasing securities, which we will then sell back to the market.
So because of Section 14 of the Act, maybe the simple way of saying it is others are lending money to the federal government. You are purchasing those loans. And then the interest payments being made to you because you're now the holder of the, or you're the official maker of the loan, are then remitted back to the Treasury. So maybe in layman's terms, this is one part of the government lending another part of the government money, which would not lead to long-term confidence once the American people understood the basics a little bit better.